Hi there, Mike Brady with Generosity Wealth Management, and I'm recording this on a Monday morning, August 15th, and hopefully you're getting this in your email Monday afternoon. With every day being so very important and newsworthy, I want to get this out as quickly as possible. Last week, big swings, 400 plus or minus, and just unbelievable. The volatility's on Friday and on so far today is starting to tamper down, which is great. I think that anyone who believes in efficient market theory is just, I'm not there. I'm not on the bandwagon with them. What that really says is that the available public information is factored into the market. And when you're seeing huge swings like that, I think you're seeing a lot of emotionality. You're also seeing a lot of short covering, and you're also seeing some program trading, people who have got losses in there or various triggers at various points just starting to execute automatically. I make no judgment about any of those techniques or reasons. It's just they are what they are. Right now, I think what we need to ask ourselves and what the market is asking is, are we in a recession, and is the euro going to survive? Because euro, I think, is going to be Europe, and the euro is going to be a big driver going forward in the next quarter or two. I think we're seeing a year and a half of, if you've been watching my videos, it's starting to implode, and so it's starting to slow up. Starting to speed up, and some major decisions are being made at this point in time. Are we in a recession? I think we are in a recession. We're going to look back 3 to 6 months from now and say, gosh, we were in a recession then, even if the numbers don't say so right now. There are some bearish indications that have me concerned. One of them is just 4 down months. If August is a down month in the market, that is definitely a clear sign of that we're in a recession. Sorry, I'm just looking at my notes here. Second is just the market volatility. You don't see this kind of volatility in a bull market. You see this kind of stuff in a bear market. The third is just the sentiment of the investors, and it's really quite negative. That's also a bear signal. And the fourth is the Fed. At the end of the day, when you look in between the lines of what the Fed is saying, the Fed is saying that we're in a recession by the tones that and overtures that they're giving. There are a couple of things that I think that you need to do, kind of getting back to some practicality here. Look at your portfolio and make sure that you're not, and rebalance. You probably have various mutual funds, ETFs, stocks, etc., and make sure that you're not completely out of whack. If you used to be 10% this and now you're 15 or 20, you really don't want that. Now's the time to evaluate it. The second is for your particular categories. Let's say that you've said, oh, I want a certain percentage in large cap or small cap or internationals or whatever it might be. Make sure that you've got the best in class. When's the last time that you reviewed the particular mutual fund, ETF, index, etc., to ensure that it's performing the way that you think it should perform? In the last couple of years, we've had mainly kind of a nice bull market, and so now we've had a week or two of down, and so the question is, did it perform the way it was supposed to? So is there any change within that category that you need to make? I still believe that internationals are something that you ought to have a very small, if any, position in. I do have some international exposure, but it's extremely small, and because getting back to what I said earlier, I think that's going to be one of the major drivers going forward. The last thing you can do is look at your municipals. I have a friend of mine who we spoke last week, and he, I think, pretty much thinks I'm crazy in some of my pessimisms with municipals. That's okay. At the end of the day, I could be completely wrong, and municipals could do fine going forward and maybe even have a little rally. That's fine. But the question is, I think, is the risk is too great out there. Your downside versus your upside. With the yields between 1% and 4% for these municipals, sorry, that's not very exciting to me for the risk that you're going to take. And I think the risk on the downside, if we have some defaults, is just greater than what the upside potential is. That's just my analysis. I could be completely wrong as it relates to municipals, but it's just the risk-reward ratio isn't there for me. That is what I'm thinking about right now. One thing that I'm going to let you know is I've been working very hard for a number of months now on some dynamic asset allocation models. I'll be talking about that more individually with my clients and also writing about it in my newsletter, etc. It is just another investment management strategy that I want to kind of complement some of the other things that I'm doing with my clients and offerings for prospective clients. So I'll be talking about that in the coming weeks. Also, if you don't get another video from me this week, this is a good thing. Not that you don't hear from me or that I don't have to do another video. It just means that maybe things have settled down a little bit, and so you don't have to every single day say, oh my gosh, what's going on? What does this actually mean? What's this mean for me over at Generosity Wealth Management? So if you don't get a video from me, that means that, maybe we've settled down this week, and that we're not quite on the ledge as we were maybe a week or two ago. So anyway, Mike Brady, Generosity Wealth Management, 303-747-6455. And you have a wonderful day and maybe a wonderful week. Bye-bye now.